Hi everyone, Jeff Yasteen here. Make sure to subscribe to our YouTube channel. Follow me on Twitter at Jeff Yasteen and on Facebook where my username is Jeff Yasteen1. Also, make sure to leave comments and to share this video with others. Now, every so often I post something on my Twitter feed that I call Words That Haunt Us. I go back and I look at what Wall Street strategists were saying just before and sometimes weeks after what's recognized as the start of a past bear market or sharp correction. So I posted this one about a month ago showing what well-known strategists in the year 2000 were saying after the NASDAQ fell sharply in March of that year. Then it rallied strong all summer through Labor Day. Now, no one at that time wanted that tech bull market of the era to end even after the sharp decline earlier in the year, and you can see that from the comments. I am encouraged by the fundamentals, says one strategist. Another says everybody wants to own these technology stocks because the earnings growth is so strong. And a third says the earnings among tech companies this year, the year 2000, will be up something like 30%. So there you go. I mean, lots of reasons to stay long, yet what happened? I mean, long and wrong, I guess is the way we would put it. And the truth is, everything looks fine on Wall Street until it doesn't. A month after those strategists made their comments, you can see it on the chart there, the NASDAQ tech index is more than 20% lower than it was on Labor Day, and it fell even further from there. So if there's anything that stands out to me in my years watching, reporting, and then investing in Wall Street's playground, if you will, it's this. Wall Street reserves the right to change its mind, from bullish to bearish. For instance, right now, even with the NASDAQ and the S&P 500 down 5% or so, the expectations among Wall Street strategists remain very upbeat, bullish. Most seem to expect the stock market to breeze through this seasonally difficult part of the year and then onward and upward from there. So we have to ask ourselves the question, what if they're wrong? What if the experts are wrong? In my own investing and trading, I like to assume the best, but prepare for the worst. And one way to do that is with bear and leverage bear ETFs, exchange traded funds. Now, we've been in a roaring bull market for so long, lots of new investors don't even know what a bear fund is or the risks and rewards of these kinds of speculative assets, or how they can help us get through a correction or, yes, a bear market with our portfolios in at least somewhat better shape than otherwise. So more on that in a moment. So first, what is a bear ETF? Well, it's an ETF that goes up when the index that it's based on goes down. And we can see a really good example of that in this chart of the S&P 500 from 2007 through 2009, when the financial crisis took the index down 60%. Now, a bear ETF, like the ProShares short S&P 500, symbol SH, rose by roughly the same amount as the S&P 500 fell. So it looks like a positive mirror image, or nearly so, to the S&P 500's decline into negative territory during those years. Now, there are nearly 100 different ETFs of this type that you can trade. Sometimes they're called bear funds or inverse ETFs, especially if they're focused only on a specific sector or for things like volatility. They're also leveraged inverse or bear funds. You can buy or sell a leveraged bear ETF the same way you can any other, but under the hood, the ETF's managers use various kinds of derivatives, options, futures, short selling, swaps, to double or triple their bear fund's return, or at least attempt to do so, presuming the index goes in the opposite direction. And I can show you a recent example of that from the S&P 500 earlier this year when it fell nearly 40% during the first stage of the pandemic. Meanwhile, a 3x or triple leverage bear ETF like the Ultra Short Pro S&P 500, symbol SPXU, rose 136% in the same period of time. So you can see how effective, at least on paper, a bear, inverse, or leveraged bear ETF can be. But these kinds of products come with their own set of risks that is very important for you to keep in mind if you choose to go further. First, it's possible to lose money on a leverage bear or any kind of bear ETF, the same as any other ETF or stock. If you get it wrong, if you get the direction wrong, you'll lose money. Two, in my opinion, bear funds, especially leverage bear ETFs, are for short-term trading only, a few weeks or a handful of months at best, presuming you get the direction right and it keeps going in that direction. You're in it for a specific period of time when the stock market or sector that you're targeting appears vulnerable and confirms that for you. And if the market doesn't go down as you expected or instead begins to head higher, you need to be able to cut your losses at some reasonable amount. Three, if you're going to buy one, you need to do it early in the declining trend, in my opinion, when the idea of a bear market or sharp correction is not yet front page news, when it's not expected by the majority of investors. In other words, if you're seeing a stock market decline, double-digit decline, new bear market, whatever, as the lead story on your local paper or on NBC's Today Show morning show, and that's the point where you decide you're going to get short, the chances are, the odds are that you're probably too late. You might even be buying into, you're choosing to go short or choosing to become a bear right at the point where quite often an index will bounce and bounce hard. And that's another factor that you have to keep in mind when trying to make money in a bear market, by betting against the broader market, because it's like riding a bucking bronco. And so, if you get in at the wrong time, you could be trying to go short with one of these leverage bear ETFs right at the moment where the market chooses to rise sharply. And I've said this a few other times in previous videos that quite often in the midst of bear markets is the point where the indexes, like the Dow, like the S&P, and like the NASDAQ, have posted some of their strongest single one-day percentage gains, simply because it's at that moment that everybody chooses to get short, and that's the moment that a lot of the seasoned professionals on Wall Street, the traders that is, are using to then go long because they know the market is leaning too far, or the majority of investors are leaning too far in the other direction. So that's why I say with one of these leverage bear ETFs, especially any kind of bear ETF, you need to be conscious of that and choose to get in early rather than later, where I judge that your risks are even higher than before. Also, even if a bear fund says 3x or 2x, you're probably not going to double or triple your money, even if you bought at the absolute top and sold at the absolute bottom with one of these inverse funds. And that's because of something called skew. In mutual fund industry terms, skew is the additional cost and the small losses incurred as fund managers try to keep their bear ETF negatively leveraged against an index. So think about it. If the NASDAQ 100 index goes up instead of down, a leverage bear NASDAQ fund would need to readjust all of its positions in the futures markets, options market, the swaps market, and those constant adjustments, which are done pretty much all day long, mean leverage funds all tend to lose a little something extra on a near daily basis. And five, because of that skew over long periods of time and because of those costs involved, and also the stock market's general tendency to go up, or at least not go down, or go down as quickly as we often fear, these kinds of funds, especially leveraged ones, have a tendency to head towards zero over long periods of time. That's why I say they're for short-term trading only, in my opinion. And you can kind of see that on a fund, any kind of leverage bear chart like this one, that especially obviously in the midst of a long-term bull market such as we've had, these funds all generally heading from the upper left down to the lower right, which is not the kind of chart you want to buy into unless you're trying to get that bottom, and obviously you're also trying to get that top of the stock market. So as the market heads down, one of these funds heads higher. You just can't overstay your welcome more than anything. So it brings to mind the question, why buy one of these leveraged bear ETFs at all? Well, across this whole class, they offer a simple way to speculate on a downturn, a little or a lot. I think that's a good tool to have if you use it wisely, and especially if you don't have access to options or the ability to short sell, such as in a 401k or an IRA. You can also use a leveraged bear fund to at least partially hedge an existing portfolio of long positions. Now, how much you want to do that and whether it's more effective to hedge, using options or short selling, is up to your own judgment and the capabilities and allowances of the account. If you're using a leveraged bear ETF though, even a small position can go a long way if you're getting it right, because if you're getting in early in the downtrend and the market falls, say, by double-digit amounts, obviously you stand to do quite well. If you're wrong, you can still cut your losses quickly as the market moves to new highs. And more than anything, the key, the way I look at these sorts of things, bear ETFs, leveraged bear ETFs, is look at it like yet another stock that you're trying to buy low and sell high. And whether that means buying it, and holding it for 2 weeks or holding it a few months, obviously a lot depends on whether you have a view in particular regarding whether, the overall market in this case is heading into a long-term bear market or just simply a short correction of a handful of weeks. We all have to make that judgment on our own. That's not something that I have a crystal ball on. But the main thing I want to point out here is it's nice when you have a portfolio of long positions. Hopefully you're diversified and they're not all going down at the same level, right? But the key here, it's always good to have something working in your portfolio, even in these kinds of situations. There are different ways you can do that. You can buy certain kinds of emerging markets that have a tendency to go up when our market goes down. But again, there are no guarantees on that sort of thing. Having something like a leveraged bear ETF though is yet another tool that you can use. And the other aspect of all this that I just want to point out is that the toughest part about a bear market or sharp correction is simply that at the bottom of one of these, and we never know where that bottom really is, but at the bottom of one of these where a lot of the stocks that we really like tend to get really, really cheap, the toughest part is at the bottom, you're so battle scarred and so sort of bombed out by the decline of the market and the damage it's done to your overall portfolio that it just makes it hard to act on these cheap stocks when they get down to those levels. And obviously it means you have to take a little bit of a risk at those points because you've watched your market or your stocks go down and down and down, and now suddenly you have Home Depot at 15 or 20 bucks, those sorts of things. Or I pointed out the other day how Apple back in late 2018 and early 2019 was actually at a really cheap price and was very viable there. But in order to take advantage of those, you have to have that psychological mindset that you're still willing to take those risks. And that is a tough thing to do for anybody when you come out of a bear market. So that's why I say sometimes it's nice at points like this where things are very high, there's a lot of interest in the market, and there are various clues out there that say maybe it's time to pull back a bit, all right? It's not such a bad idea to perhaps find different ways to take less risk with your portfolio. Leverage bear ETFs offer you one tool to be able to do that. If you like what I'm talking about, make sure to keep following us on YouTube, subscribe to our channel, follow me on social media. I'm Jeff Yasteen.